This is part 4 of the presentation associated with having a non-controlling interest, and it primarily focuses on the working paper entries when there's a non-controlling interest and the parent for the investment account uses either the equity, initial value, or partial equity method. Now, for example, on January 1, 2016, Mike Tech acquires 70% of Danny Tech for $560,000. The 30% has a trade value of $240,000. Dan Tech had common stock of $400,000 and retained earnings of $200,000. A patent was undervalued at $50,000 with a 5-year remaining life. Danny's net income and dividends were, for the next 3 years, $590,000 for net income, and he paid out $140,000 in dividends. At December 31st, Mike Tech owed Danny Tech $25,000. What are the worksheet entries under the equity method, the initial value, or partial value method? First, determine if there is any premium or goodwill. So, there is no premium because if we take 560 plus the 240 equals 800,000, or if we take 560 divided by 70%, you get 800,000, so there is no premium. Now, goodwill. The consideration is 800,000 less the book value gives you a difference of 200,000. The amount assigned to undervalued assets was 50,000, which gives us 10,000 a year amortization, and we have been able to estimate that goodwill is 150,000. Now we can do our journal entries, and we'll start with journal entry S. We're going to take the common stock and the retained earnings, and remember the retained earnings are as of 1/1/2018. So we're going to take 440 is what the balance would have been in the sub, and then we're going to credit the investment account in Danny for 588, the parent at 70%, and the non-controlling interest would get the 30%. Now here's the thing to remember is at the end, when you make all these adjustments, you should have zeroed out that investment account. Next, we're going to do entry A. We're going to recognize unamortized portion of fair value allocations. Now the patent would have been amortized for previous 2 years, so now it has a net value of 30,000. The goodwill would not have changed, and then we're going to assign 70% to Danny and 30% to the non-controlling interest. Now for the acquisition method again, we recognize 100% of the assets and the liabilities. Next thing we're going to do is remove Danny's net income recorded on the parent's books, but remember we would have only recorded 70%. And then of course we'd have that other entry in that non-controlling interest column. And we're going to eliminate the current entity dividends. Again, we would only take 70%, and then there'd be that item for the 21,000 that would be assigned to the non-controlling interest. And then we would book the amortization. And the last thing we would do is remove the intercompany accounts receivable and accounts payable. So again, there would be that non-controlling interest column, as I said before, and we would be adjusting net income by 81,000, subtracting that out, and we would be showing dividends at 21 would be their share. Now, what happens if they'd use the initial value method? The initial value method ignores 2 accrual-based adjustments. The parent does not accrue the percentage of subsidiary net income earned, and the parent does not amortize. Entry C is added to the worksheet to convert the previously recorded balances to the equity method. Entry C is used to convert to the equity method. The increase since the acquisition in the subsidiary's returned earnings during past years, net income less dividends, based on percentage ownership, the parent's percentage of total amortization expense for these same 2 years. Entry I removes both entity dividend income and subsidiary dividends to the parent. Entry D is unnecessary. So we would say our investment balance, and then it would have been adjusted for the 2 years of net income minus dividends times 70%, less 70% of the amortization. So our balance at January 1, 2018 would be 714. The balance in our investment account would be 560. So what we have to do is adjust it to by 154,000. We need to adjust retained earnings by 154,000. Now, what if we use the partial equity method? Well, if the parent used the partial equity method to account for the subsidiary after acquisition, entry C is used to convert, and there all we have to worry about is the amortization. Under the partial equity method, the parent accrues its share of reported subsidiary income, but it does not recognize the excess fair value amortization. So again, the 560, we would have adjusted for the net income and the dividends, so that would be the balance in the investment account. The only thing we really need to adjust for is 2 years worth of amortization at 70%. So our journal entry would be 14,000, 14,000. And that ends our presentation of the entries based on the method used to account for the investment account by the parent.